Hall and Wilcox acknowledges the traditional custodians of the lands on which this podcast is recorded. We pay our respects to their elders, past and present, and to all First Nations people joining us today.
Hello and welcome to the first episode in the latest season of Tax Records. In this episode, we'll be discussing the R&D Tax Incentive Program and the broader risk and governance considerations for businesses. My name is Ruby Wenza and I'm a lawyer in the tax team here at Hall & Wilcox. Today, I'm delighted to be joined by my colleague, Gloria Lim, who is a senior associate in our tax team. Gloria is a tax lawyer who advises on corporate tax and M&A transactions and has previously worked in R&D tax.
Hello, Ruby. Thanks so much for having me. I'm glad to be here.
At this time of year, businesses with a 30th of June year end are often focused on preparing their FY25 R&D claims ahead of the 30th of April lodgement deadline. That process is typically centred on ensuring that statutory eligibility requirements are met, but that's not what we're here to talk about today.
That's right, Ruby. During this period, when there is a bit more focus on the R&D tax incentive for businesses, I thought it might be a good time to take a step back and look at the broader implications for the business as a whole, particularly what it means for those responsible for overseeing risks and governance of the business. I'm thinking, for example, of legal counsels and their team who may not be involved in the R&D claims process, but are very much responsible for managing a business's legal risks and governance. Or in a startup context, a founder who needs to understand the broader and longer term considerations beyond making their very first R&D claim.
So the R&D tax incentive can also be relevant to non-tax practitioners?
That's right.
With that in mind, could you give us an overview of the R&D tax incentive, what it is and how it operates?
Of course, the R&D tax incentive is a government program. It is one of the main ways in which the Australian government encourages businesses to invest in research and development here in Australia. The purpose of the program is to encourage Australian businesses to innovate and ultimately be more competitive. It does this by providing a tax offset on a company's eligible R&D expenditure, which helps to reduce the cost of undertaking research and development work that is often risky or commercially prohibitive because the returns, if any, may be longer term or uncertain. At a high level, depending on a company's tax profile, the tax offset can be refundable or non-refundable, and the applicable offset rate will vary based on the company's tax profile. Very broadly, eligible companies with an aggregated turnover of under $20 million may be able to access a refundable tax offset rate of around 43.5%, while larger companies over that 20 million aggregated turnover threshold may be able to access a non-refundable tax offset rate between 33.5% and 46.5%. A refundable offset just means that if the company doesn't have enough tax to pay to use the offset, the access is refunded as cash. In other words, the benefit isn't lost simply because the company is not yet profitable.
I guess my next question is, how is a tax offset different from a general deduction that businesses usually get?
So a general tax deduction works by reducing the company's taxable income, not the tax it has to pay, not directly. In contrast, a notional deduction for eligible R&D expenditure reduces the company's tax bill directly. You calculate the tax payable first and then apply the offset to reduce that amount, which is also at a much higher rate. So assume a company spends about $100 on R&D, and it's a smaller company with a 25% corporate tax rate. Under a normal deduction scenario or general deduction scenario, the $100 reduces the company's taxable income by $100. Very broadly, that means the company pays $25 less tax than it otherwise would have, simply because it has less income to be taxed. Under the R&D tax incentive scenario, the same $100 where it's eligible R&D expenditure will then instead attract a tax offset at a rate of 43.5%, This will result in a $43.50 reduction in tax payable or cash refund if there is no tax payable.
That's a significant difference, especially given the potential for the offset to result in a cash refund.
That's right. So based on the most recent data we have, total R&D expenditure claim for the 2022-2023 income year was about 16.2 billion. Of that, public and national businesses accounted for around 8.5 billion, so over half in terms of dollar value, while small businesses made up the largest group of claimants with over 6,000 companies, representing about 46% of all claimants.
When you look at the program on that scale, it becomes clear why it attracts so much attention, particularly from the ATO.
Yeah, that's right, very much.
That brings us to what we really want to focus on today. With this context in mind, what are the broader risks and governance implications for businesses that claim the R&D tax incentive? In particular, what does it mean for non-tax practitioners, such as legal counsels and in-house legal teams, who are responsible for overseeing corporate risk and governance, but who may not necessarily be involved in the R&D claims process? What should they be aware of?
I think you framed it exactly right, Ruby. The starting point is awareness. Having some understanding of how the R&D tax incentive operates and the process that the company undertakes to make its annual R&D claim is important. That can help, for example, in-house legal teams better assess the risks particular to their organisation and allow them to put in place the right processes or governance frameworks for their organisation to manage those risks. Having said that, there are a few things that people overseeing risks and governance of companies that claim the R&D tax incentive should be aware of, beyond just considering whether claims made meet the statutory eligibility criteria. Firstly, it's important to understand the review and audit risks. The R&D tax incentive is jointly administered by the Tax Office and AusIndustry, and both bodies have review powers. As a general rule, the Tax Office focuses on the eligibility of expenditure claimed, while AusIndustry looks at whether the taxpayer's registered activities qualify as eligible R&D activities. However, it is important to note that the eligibility of R&D activities is not the sole purview of AusIndustry. So where AusIndustry has not formally reviewed or made a finding on a taxpayer's registered activities, the Tax Office can still assess and form its own view on whether those activities qualify as eligible R&D activities. So from a governance perspective, it is important to understand who can review what and where exposure may arise across both regulators. Secondly, it's important to be aware of industry-specific concerns highlighted by regulators. AusIndustry has released guidance tailored to different industries, setting out what qualifies as eligible R&D activity for particular industries. Because the eligibility rules can be difficult to apply in practice, understanding the common issues that arise within an industry can help, to some extent, de-risk claims by managing known risks and issues. Thirdly, it's important to be aware of the existence of the R&D tax incentive transparency report that is published annually. Included in that report is a list of all R&D tax offset claimants, including company names and the R&D expenditure they claim for that particular year. From a risk and governance perspective, the transparency report raises a number of important considerations. Greater public scrutiny and greater risk to reputation, for example, if the claim is later found to be incorrect or overstated. There is also a competitive or information risk. While the transparency report does not disclose technical details or intellectual property, the publication of R&D expenditure levels can give competitors insight into the scale of a company's investment in innovation. Companies and their legal teams should be aware that this information is available to the public and consider whether there are broader commercial considerations that need to be managed as a result. The ATO has been clear that the transparency reporting is intended to increase public accountability. This signals greater scrutiny over time, so it is even more important to ensure appropriate governance frameworks are in place before that scrutiny intensifies. The final 2 points I want to touch on are more practical in nature, based on what I've seen in practice and what our team have been asked to advise on. R&D claims for large companies can often be treated as largely technical exercises between the finance team, tax advisors, and the R&D team or engineers. There can be limited involvement from in-house legal teams or other advisors. When that process is siloed away, there is a risk that broader eligibility requirements are not fully considered, particularly the R&D integrity rules, which consider arrangements around the R&D activities to ensure that the claims relate to genuine R&D activity of the company. Legal teams can play a crucial role here, as they are often the ones who have a better understanding of the broader arrangements that are in place for the business and may be involved in their setup or the drafting of the contracts that govern these arrangements. Therefore, they can be best placed to identify integrity risks that don't jump out from a technical tax analysis in putting together an R&D claim. Things like intercompany arrangements, who owns the IP, and how the broader corporate structure operates. In some cases, the arrangements can directly affect eligibility or even prevent a company from accessing the full benefit it expects. So it is important for in-house counsel and others responsible for corporate risk and governance to understand how existing or proposed contracts and arrangements may affect the R&D claim that the company is making. The last point is that in a transaction context, buyers or investors need to consider the historical R&D tax incentive claimed by a target company. So where the key risk areas are, how robust those claims are, and whether any exposure needs to be managed through pricing, warranties, indemnities, or other types of provisioning.
These considerations will apply to smaller businesses that may not have the benefit of an in-house legal team. Is this something they should look at or direct to the attention of their external legal advisors?
Absolutely. In those cases, it may be that the owner or founder or their external advisors, those are the people that need to be aware of these broader issues.
That's a really helpful overview. Let's look at the first of the last 2 points in a bit more detail. What are the integrity rules that can derail an R&D claim, and what role does legal counsel play in protecting against them?
Sure. So the first rule is the arm's length rule, which operates to reduce R&D expenditure to market rate, where the amount paid between related parties is inflated. This is particularly relevant when you have a group structure. So say a parent company charges a subsidiary for R&D services, or a company is paying a related party contractor to conduct its R&D activities. If the price is not at arm's length, the access is simply disallowed. So the point for the in-house legal team when drafting or reviewing intercompany agreements that involve R&D services or cost-sharing agreements is whether the pricing has been benchmarked against market value. In that way, it's not just about being the in-house legal team being aware of R&D tax issues, but what they and their teams can actively do to support overall compliance and risk management of the company's R&D claims. The second rule is the at-risk rule, which considers who actually bears the financial risk of the R&D activities conducted. This rule can operate to limit an R&D claim to the extent that the R&D entity has received or will receive consideration as a direct or indirect result of incurring expenditure on R&D activities. In practical terms, if a company is receiving funding from a third party under a contract to conduct R&D on behalf of someone else, or for that third party, and those amounts can offset or completely cover their R&D costs, then those costs won't be eligible for the R&D incentive, because the basis of that, the R&D incentive, is that it's supposed to cover expenditure that would be uncertain or difficult to recoup for the company. The key point for, say, a legal counsel is that this analysis can turn entirely on contractual arrangements in place, in particular when you have investors coming in at a later stage and looking at funding some of your R&D activities. Then the question is whether you've set up an agreement that gives the company a right to recoup its R&D expenditure from that investor, regardless of the success or failure of the company's R&D activities. The third rule is the effective ownership rule. This rule examines who really owns the intellectual property developed or the results of the R&D activities, who has control over the way activities are conducted, for example. It's a control and ownership question. So if a company conducts R&D activities under the direction of another entity and does not own the results of the activities, and additionally does not bear the financial risk of the activities, it will not be eligible for the R&D tax incentive. For in-house legal teams, the key takeaway is that the IP ownership or the intellectual property ownership, contractual control, and who bears financial risk can be decisive or can affect R&D eligibility. If the company is effectively acting as a contract R&D provider with no real ownership or risk, the incentive is likely to be unavailable, and it will present a clear governance and tax risk if a claim is made.
So, in a sense, in-house counsel or non-tax legal advisors are often best placed to spot these issues. Oftentimes, they are the ones who have drafted or negotiated those contracts or arrangements.
Absolutely. If they are involved early on, it allows for more coordinated effort and reduces the risk of accidentally breaching the R&D integrity rules.
Turning now to addressing R&D tax risks in M&A transactions, what are some of the key considerations around the R&D tax incentive that typically arise in transactions?
So in a share sale, you buy the company or interest in a company, as opposed to in a business sale where you buy its assets. In a share sale, you then inherit the historical tax issues of the target company. So in that context, on the buy side, and if you are the buyer or advising the buyer, some clear red flags to look out for include any correspondence with the ATO or AusIndustry relating to reviews or audits, as well as any amended assessments or voluntary disclosures connected to R&D claims. It may also be relevant to check whether the company has sought any advance findings for R&D and what the outcomes of those applications were. Oftentimes we will ask these questions up front as part of a tax due diligence. Particular attention should then be paid to activities that sit in known risk areas. So if you've got a R&D claim that relates to software development, or you have offshore R&D activities or significant related party arrangements related to R&D, or there are some patterns or arrangements to the R&D activities that have been flagged as being under review by the ATO. Typically, if we see those patterns emerging, then we will flag and consider them. Ultimately, if someone is acquiring shares in a company that conducts R&D and has historically claimed the R&D incentive, they're effectively inheriting that risk, as I mentioned, and the significance of that risk will depend on a few key factors as part of the transaction. So how big is the historical R&D claim? What's the relevant review period? So which of the claims are still open for review? And thirdly, materiality of the overall transaction. So materiality in a transaction refers to an amount, a threshold amount, at which, in this case, tax misstatements, omissions, potential liability becomes a significant issue, significant enough for the buyer or enough to influence the decisions of the buyer. In a tax due diligence process, what we're typically looking to do is get comfortable that there's a robust process underpinning the R&D claims. That means assessing whether there's sound tax governance in place, who's advising on the claims, what the internal processes look like, and whether there's contemporaneous documentation supporting the positions taken. If the R&D claims are particularly significant, that might warrant going a step further, bringing in specialist advisors to actually review the claims themselves rather than just the process. But in most transactions, this ultimately feeds into the protections that you bring into the deal. So you want to ensure there are adequate warranties in place, and where the exposure is material, potentially you might want to include specific indemnities that directly address R&D risks. Where a company is acquired, the buyer inherits the company's history, so including any existing risk associated with past R&D claims. R&D claims can become an issue if the claims are later found to be non-compliant or ineligible. Just to round this out, there are a number of things that will typically come up in tax due diligence around R&D, and they're often quite transaction specific.
What do you see most regularly and may be valuable for our listeners?
I'll leave you with two that I think we see quite regularly and consider quite regularly. They tend to be more operational or post-transaction issues. While they may only come to the fore once you've completed the deal because it's post-transactional and you're thinking about what happens next, that they really should be considered or flagged at the time you enter into the deal. So the first relates to franking or franking credits. If you are acquiring or investing into a company that has historically been claiming the refundable R&D tax offset, it is important to understand that those cash refunds are effectively debited against the company's franking account. So when a loss-making company receives refundable tax offset, the refunded amount is recorded as a debit to the company's franking account. That means if the company later becomes profitable and starts paying tax, any franking credits it generates can be offset by those earlier debits. As a result, if the company distributes profits to shareholders, there may be fewer or no franking credits available. Similarly, where a profit-making company accesses the non-refundable R&D offset, it means it's paying less tax overall because the R&D offset reduces the amount of tax it pays. This then means that it will have fewer franking credits, which again limits the ability to pay fully frank, which can limit the company's ability to pay fully franked dividends to its shareholders. So in practical terms, this means that an investor or as a legal counsel advising the buyer in a transaction, you may need to explain to stakeholders that the company may not be able to pay fully franked dividends for a period following the acquisition. If distributions are made, they may be unfranked, so shareholders may be required to pay their full personal tax rate on the distribution received. The other point that can often be overlooked on the buy side is whether the R&D benefit the target has historically claimed will continue post-transaction. So if the R&D credits that the target receives is a material part of the investment rationale, that is, it's one of the main reasons the company, the buyer is purchasing or investing into this target company, it is then important to assess whether the target company will remain eligible for the R&D tax incentive after the completion of the deal. As we discussed earlier, when a company claims the R&D tax incentive, eligibility can be affected by who owns the IP, who controls the R&D process, who bears the financial risks of the work. These factors can change as a direct result of a transaction if, after the acquisition, IP is reorganized, for example, moved into a new holding company, licensed to another group entity, or transferred offshore. Or, for example, if funding arrangements change so that a different entity is effectively underwriting the R&D or guaranteeing returns. What can happen is that the entity actually doing the R&D work or the target company that's been acquired may no longer be regarded as the one that owns the results or bears the real risk. So it's no longer eligible to claim the R&D tax incentive.
And if we flip that around to the sell side as opposed to the buy side, when you are on the sell side, what should you as the founder or legal counsel for the seller be doing to prepare?
On the sell side, it's really about being prepared and having your ducks in a row. We often see this come up when a startup is selling to a larger company. So firstly, given that the R&D tax incentive is a self-assessed regime, where a business has claimed in sort of high risk or more contentious areas, typically software R&D claims, it can be very helpful for the seller to undertake an independent review of past claims before a buyer's due diligence process begins. That way, if there are any eligibility issues, they can be identified and addressed early rather than becoming a surprise during due diligence. Secondly, sellers should make sure their R&D documentation is complete and up to date. That includes keeping on file records of R&D applications lodged with AusIndustry, R&D tax schedules submitted with the income tax returns to the tax office, and their sort of contemporaneous supporting materials for their R&D activities. They could include expenditure work papers, invoices, contracts, timesheets, and other records of their R&D activity actually taking place. It should be noted that usually in the share sale agreement, there will be a clause setting out that a requirement to exchange documents or records. So the seller will provide to the buyer all required documents or records, and these will usually include the necessary R&D records. So R&D claims never sit in isolation. In an M&A context, they may be part of the broader risk profile for the company or its legal team. Even if they're not deep into the technical details or the eligibility criteria, having a working understanding of how the R&D incentive operates will help them identify where the hidden risk or the real value actually lies.
We've covered a lot of ground today. To close us out, Gloria, what are the key takeaways for listeners when it comes to the R&D tax incentive and broader risk and governance considerations?
If I had to summarise this in 2 points, I would say first that the R&D tax incentive should not be viewed solely as a tax or finance matter, and particularly in larger businesses. Eligibility depends on legal and governance factors as well, because as we touched on, it can be relevant to IP ownership, contract arrangements, and where financial risk sits. These are all important considerations. This is particularly relevant for in-house counsels and the legal teams who may not be involved in preparing R&D claims, but are responsible for overseeing these broader risk considerations. Second, R&D claims need to be assessed on a forward-looking basis, particularly in a transaction or like a business growth context. Historical claims don't always mean that you will continue to be eligible to claim. It's an annual assessment that you have to make. Early involvement of the in-house legal team or those whose responsibility it is to manage risk and governance of the company can help risk-proof or de-risk the R&D claim that a company is making. For example, ensuring changes to structure, funding, IP ownership do not unintentionally affect ongoing access to the incentive.
Thanks everyone for listening today. As always, please get in touch with us if you have any questions. You can find our details on our website, which is hallandwilcox.com.au, or connect with us on LinkedIn. If you have enjoyed today's episode, then rate, review, or subscribe to our podcast wherever you get your podcasts. Thank you.
This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.